Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage. Welcome to another edition of Java with Jared. Happy Friday. Boy, it was a real volatile week here, especially in the stock market, with rates actually benefiting by a real big drop in the stock market. And we're ending the week better than where we were last week. In terms of economic data, we saw housing starts come in, and that showed an increase of about 0.2%. That was the highest number in about 8 years. We also did see builder sentiment actually go up, and that was like the best number in about 10 years. And then existing home sales came in, and that showed also better than expected increase at about 5.59 million units when expectations were closer to about 5.48 million units, and versus the previous month at 5.42. So from the housing sector, all real positive stuff. We did see the CPI come in actually weaker than expected. CPI measures inflation at the consumer level, consumer price index, and that showed only an increase of 0.1%, with the year-over-year number being 1.8%. The expectations were for about a 0.2% increase on the month-over-month, and the year-over-year number being about 1.9%. That didn't happen. It was a little bit weaker than expected, showing that inflation, which is interest rates' arch enemy, inflation is under control, and we're not at the 2% level that what the Federal Reserve would really like to see. But the real big news was actually the release of the Fed minutes, and that came out on Wednesday. And basically what the Federal Reserve minutes showed is that most of the members do not believe that there's enough positive economic conditions to support an increase in short-term credit. So many believed that we could see an increase to the Fed funds and discount rate as early as September, possibly October, but now it looks like September's off the table. October could be possible, and if it happens, though, it's more likely in December. What that did is that caused the stock market to start a slide. And Wednesday and Thursday and even today, the stock market is just getting hammered and interest rates are benefiting. In fact, we've lost the S&P, or actually the Dow Jones Industrial Average has lost over about 700 points. Now, interest rates have benefited, but not maybe by quite as much as some might think. Also, the important thing is that you heard me, a few months back talking about, at least with mortgage-backed securities, us breaching the 200-day moving average line of support, and we breached that, and that indicated that we could see interest rates increase, which did happen. Well, on the other side of the equation now, we have significantly breached the 200-day moving average on the equity side. So that could signal that stocks could be in trouble for a little bit and can continue to slide, and we might see interest rates benefit. Also, the 10-year Treasury yield is actually broken the 200-day moving average on a positive side for interest rates, so that's good. We are right up against the 200-day support line on the other side on mortgage-backed securities, so we haven't broken that level yet, and if that does happen, that would be a positive indicator for interest rates. But again, real wild week here, and it's only due especially to the stock market, and the impetus of all that was the Federal Reserve note. So we'll keep you informed. We'll let you know if this continues to really play out over the next couple of weeks. But the bottom line is that, for the rest of the year, interest rates are going to continue to be probably pretty good levels. So if you have any questions, always give me a call. If you're working this weekend, so are we. Thanks for joining me with Java with Jared. And again, we'll keep you informed on all this volatility. Talk to you soon. Bye-bye.